By making enormous amounts of credit easily available, the Fed can also drive down interest rates, sending out the wrong signal to investors. It sets in motion an unsustainable investment boom that carries with it the seeds of its own destruction. It's this business cycle that is ultimately responsible for economic disasters such as the Great Depression. Soon after the Federal Reserve was established, the U.S. entered World War I. Once again, the government temporarily abandoned the gold standard to print more money to finance the war effort. The U.S. government borrowed heavily, and the national debt ballooned from $1 billion to $27 billion. A sharp spike of inflation followed. This set off a cycle of rapid expansion and contraction in the economy. To dampen the overheated economy, the Fed halted its inflation, causing interest rates to nearly double over the next 18 months. By 1921, the market began to recover. New technology helped to increase productivity. Markets developed for new cars and appliances. The 1920s were a period of extraordinary growth. But behind the scenes, much of this growth was distorted by a Fed-generated inflationary credit expansion.
This was the Roaring 20s. This was a period of increasing affluence. That hid the inflation from American economists.
The Fed-generated bubble burst in the Wall Street crash of October 1929. Speculators who had borrowed money to buy shares when bank credit was readily available saw the stock market lose 1/3 of its value. Bank loans totaling $7 billion were outstanding. As the speculators defaulted on their loans, bank failures spiraled, and the Great Depression set in.
Depositors lost their bank accounts, both their savings deposits and checking deposits. They saw them disappear into thin air.
In 1932, Franklin D. Roosevelt was elected president and quickly implemented a New Deal policy of spending us to prosperity. Even though we needed lower taxes and lower spending, his administration would seek unprecedented amounts of money to finance its big government programs. In his inaugural speech on March 4, 1933, Roosevelt vowed to put an end to poverty and the unemployment lines and get people back to work. It didn't work. The Depression got worse, thanks to increased central planning. FDR only succeeded in making the monetary system even less sound. Just after taking office, the president declared a 4-day nationwide bank holiday, absolving the bankrupt fractional reserve banks of any need to repay their depositors. But before the banks reopened, the Roosevelt administration had to come up with a scheme that would lead people to believe that new deposits would be safe. It created the Federal Deposit Insurance Corporation to lull the public into a sense of security. In reality, the Federal Deposit Insurance Corporation holds just 0.5% of all the deposits it insures. But what people are counting on is that the Fed, as the lender of last resort, would step in and print whatever money would be necessary to prevent a massive bank run. By the mid-1930s, control of the Fed by the New York bankers was drawing to a close. The Morgan era ended when President Roosevelt, who was no friend of the Morgans, appointed Mariner Eccles as its governor. Eccles, a Republican from Utah, moved the activities of the Open Market Committee to Washington. President Roosevelt was on hand for the dedication of a new $3.5 million building to house the Fed.
I dedicate this building today to progress toward the ideal of an America in which every worker will be able to provide his family at all times with an ever-rising standard of American comfort.
1933 also marked the beginning of the end for the gold standard. There was no end to Roosevelt's appetite for spending on such New Deal programs as the gigantic $13 billion Tennessee Valley Authority, which flooded vast areas of productive farmland to provide government-subsidized electricity. The Works Progress Administration, which spent $11 billion on make-work jobs and pork barrel public works. But the U.S. currency was tied to gold, which limited the amount of money the Fed could print to pay for these costly projects. So the government scrapped the gold standard for American citizens in 1933, and then Roosevelt confiscated the people's gold. As in World War I, the warring parties in the Second World War abandoned the gold standard to finance the war with central bank-generated inflation. After the war, there was an attempt to use the prestige of the gold standard to establish a global inflationary system. The world's financial leaders met at Bretton Woods in New Hampshire under the direction of the famous economist John Maynard Keynes. Their idea was to set up a new international monetary system that would have both gold and inflation.
Under this system, the U.S. dollar would be redeemable in gold, but only for foreign official institutions, central banks and foreign governments, at the rate of $35 per ounce. All other currencies would have fixed exchange rates with the U.S. dollar, and they would be redeemable in U.S. dollars.
The New York Times editorialist Henry Hazlitt was one of the first to realize that this semi-gold standard would not succeed.
Even from the very beginning, it was doomed to failure, and this very outstanding journalist at that time, Henry Hazlitt, predicted it wouldn't work, because he says the temptation will always be that the government will print more money because they will accept these dollars and they won't demand the gold and won't hold the government in check. And he was absolutely right.
During the 1960s, the U.S. government was trying to meet the cost of massive social welfare programs at home and the Vietnam War abroad. By printing more money, President Lyndon Johnson believed, the U.S. government could accomplish its goals without raising taxes, which may have caused a taxpayer revolt. In other words, it could have both guns and butter.
We will make sure that every dollar is spent with a thrift and with a common sense which recognizes how hard the taxpayer worked in order to earn it.
But the more money the U.S. printed, the more it eroded the value of the dollar. Nervous foreigners began redeeming their dollars in gold, as they were entitled to do under the Bretton Woods Agreement. After paying out billions in gold, the U.S. was left with $36 billion worth of outstanding debt to foreign creditors and gold reserves worth just $18 billion.